Two of the assets you own can pass to your kids almost completely tax-free. One of them can hand your kids a tax bill of over $100,000 on the exact same amount of money. And here's the twist almost nobody knows. The difference isn't which asset it is. It's whether you give it to them now or leave it to them later. Give away the wrong asset at the wrong time, and you can turn a tax-free gift into a 5- or 6-figure tax bill for the people you love most. I'm Ray. Today, the rule called Step Up in Basis, which assets to leave your kids almost tax-free, which one is a ticking tax bomb, and the one mistake that quietly cancels the whole benefit. Quick and important. I'm not an attorney, CPA, or financial advisor. This is education, not legal or tax advice. Basis rules, state law, and estate rules vary, so always check your own numbers with a qualified CPA or estate attorney before you sign anything. First, let's define the term in plain English, because the whole video hangs on it. Your basis in something you own is basically what you originally paid for it. Buy a house for $60,000 decades ago. Your basis is $60,000. When you sell, you're taxed on the gain, the difference between what you paid and what you sold it for. Here's the rule. When your kids inherit an asset from you, not receive it as a gift while you're alive, but inherit it after you pass, their basis steps up to what it's worth on the day you die. Not what you paid, what it's worth now. Which means if they sell it soon after, there's barely any taxable gain left, because the gain the IRS taxes only counts from the moment they inherited it forward. That's step up in basis. Now let's see exactly which assets get it, and which one absolutely does not. Let's put real numbers on it, starting with the most common asset, the family home. Say Richard and Martha bought their house decades ago for $60,000. Today it's worth $500,000. That's $440,000 of gain sitting in that house. If they leave that house to their kids, meaning the kids inherit it after Richard and Martha pass, the kids' basis becomes $500,000, the full value on the date of death. Sell it soon after, and there's almost no taxable gain left. A house worth hundreds of thousands of dollars in appreciation can pass to your kids with close to zero capital gains tax. That's the power of Step Up. Now, the exact same math applies to something else you might own. It's not just real estate. Your brokerage account, stocks, funds, anything you hold outside a retirement account gets the exact same step up. Say Richard bought stock years ago for $50,000. Today that position is worth $300,000. $250,000 of gain sitting on paper. Leave it to Susan as an inheritance, and her basis becomes $300,000, the value on the day she inherits it. She can sell the very next day at close to zero tax. So remember these two, your home and your taxable brokerage account. Both get the full step up. Both can pass to your kids almost tax-free. Now for the asset that does the opposite. Here's the asset that breaks the pattern completely, and it's one almost every retiree has: the traditional IRA, or 401k. Money in a traditional IRA has never been taxed. You got a deduction going in, and the IRS has been waiting decades to finally tax it. Because of that, it does not get a step up in basis, ever. If your kids inherit a traditional IRA, they don't get a fresh basis. They owe ordinary income tax on every dollar they withdraw, at their tax rate, and under current rules they generally have to empty the account within 10 years. We covered that trap in full in video 14, links in the description. So picture this: $500,000 in a house or brokerage account can reach your kids at nearly zero tax. The exact same $500,000 in a traditional IRA can cost them over $100,000 in tax, the way we calculated in video 14. Same number, completely different outcome, just because of which account it's sitting in. Now here's the mistake that quietly wipes out this entire tax break, and it comes from good intentions. Step up only happens when your kids inherit something after you pass. If you give them the house or the stock while you're still alive, as a gift, none of this applies. Instead, your kids get what's called a carryover basis. They inherit your original basis, the old low number. So that same house, bought for $60,000, gifted while you're alive and later sold for $500,000, your kids owe tax on the full $440,000 gain. We covered this exact trap in video 4 on putting the house in your kids' names. Same house, same family, One path costs your kids close to nothing. The other can cost them tens of thousands of dollars, just because of timing. That's why, for appreciated assets like a home or stock, leaving them at death is almost always the better move than gifting them early. If you live in one of 9 specific states, there's an even bigger version of this benefit. Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin treat property a married couple built together as jointly owned community property. In most other states, when one spouse passes away, only their half of the house gets the step up. The surviving spouse's half keeps its old, low basis. On our $500,000 house, that leaves a combined basis around $280,000. Some tax still due if it's sold. But in those 9 community property states, when the first spouse dies, both halves of the house step up to today's value, the whole $500,000. Sell it right after, and the tax bill can be zero. Same house, same couple. The state you live in can be worth tens of thousands of dollars. One more piece, especially if you watched our video on selling your house, this connects directly. When a spouse passes, the survivor gets that step up on the deceased spouse's share immediately. And on top of that, if the surviving spouse sells the home within 2 years of the death, they can still claim the full $500,000 tax exclusion from video 13, not the smaller single-filer amount. Wait past that 2-year window, and the exclusion drops to $250,000. So step-up basis and that 2-year window work together, and the timing genuinely matters. Let's make this real with one family. Richard and Martha have 3 things: their house, worth $500,000, a brokerage account worth $300,000, and a traditional IRA worth $500,000. They leave the house and the brokerage account to Tom and Susan, not as a lifetime gift, but as an inheritance. Both get a full step up. Tom and Susan can sell either one almost immediately with close to zero capital gains tax. The traditional IRA is the one asset that would hit Tom and Susan with a 6-figure tax bill under the 10-year rule. So instead, Richard and Martha name a charity as the IRA's beneficiary. Charities don't pay income tax on it at all. And make sure the house and brokerage account, the ones with step-up, go to their kids instead. Same total estate, just matching the right asset to the right recipient, based on which one gets the tax break. That one decision can be worth tens of thousands of dollars to Tom and Susan. Step 1. Don't gift appreciated assets, your home, stocks, while you're alive. If your goal is minimizing your kids' taxes, leaving them as an inheritance almost always beats gifting them early. Step 2. Know which of your assets already gets step up, your home, brokerage accounts, most property, and which doesn't, like your traditional IRA and 401k. Step 3. Consider matching the IRA to a tax-exempt recipient, like a charity, and the step-up assets to your kids. And talk that through with a CPA or estate attorney, because everyone's situation is different. Step 4. If you're married, learn whether your state is a community property state. It can double the benefit. And if you're widowed, remember that 2-year window on the home sale exclusion. And the usual warning: no real advisor or estate specialist cold calls you promising to eliminate your taxes for an upfront fee. That's a scam. Verify credentials and always go through someone you found and vetted yourself. If this changed how you think about what to leave your kids, or you just realized your IRA might be a bigger tax bomb than you thought, hit subscribe. I break down one retirement money trap every single week. Tell me in the comments, did you know your house and brokerage account could pass almost tax-free, but your IRA couldn't? I read every one. Next time, the reverse mortgage. How a loan against your home can quietly eat away the very equity you just learned how to protect for your kids. If you're thinking about tapping your home equity in retirement, you'll want to see this first. I'm Ray. Take care of your money and take care of each other. See you in the next one.